Welcome to Debt Matters, the show that breaks down the latest news shaping collections, credit control, and, well, the future of cash flow management.
Today, we are analyzing some signals that are really going to redefine the next, say, 18 months for anyone managing a balance sheet or even just navigating personal debt.
Right.
The economic landscape is clearly moving, and for creditors and debtors alike, understanding the pace of that movement it's just critical.
Absolutely. And our mission today is to get past all the macroeconomic jargon and really unpack some recent commentary from a Bank of England policymaker, Alan Taylor. He's made some remarks about anticipated adjustments to the base interest rate. We need to translate those signals into practical, granular strategies for household budgets, for business liquidity, and for every step of the debt recovery ecosystem.
And the core message that came out of Taylor's recent commentary is a crucial piece of forward guidance. He suggests that we should expect rates to fall further, and critically, sooner than we previously thought. This acceleration is driven by the expectation that inflation is now set to return to that 2% target on an accelerated timeline.
And that shift in the timeline changes the immediate planning cycle for everyone involved in debt management.
It changes everything.
Okay, so let's unpack this core revelation first. For a while, the Bank of England's official forecast for inflation settling around that, magic 2% target, distant, maybe lingering around 2027.
Yeah, that was the thinking.
So what is Taylor telling us now about this revised timeline?
The central statement provides a really clear marker. Inflation could credibly settle around the 2% target by mid-2026.
Mid-2026.
Now, this might sound like a minor, calendrical shift,
Yeah.
but when you consider the inertia of a massive economy, moving that forecast forward by several months, it's a major shift in the expected trajectory.
Why does that specific date, mid-2026, matter so much to, say, a credit controller working today?
Because that is the point at which the primary mandate of the Monetary Policy Committee, the MPC, is met.
Right.
Once inflation is consistently at target, the entire economic argument for maintaining these highly restrictive interest rates, it just evaporates. This forecast provides the runway for the MPC to justify continued and systematic easing of rates.
Which fundamentally changes the cost of capital.
And the calculation of risk for every single lender out there.
And what specific data points are driving this? It's got to be more than just hope. There must be some quantitative evidence that the battle against inflation is ahead of schedule.
Correct. Taylor pointed to two main driving forces. You can think of them as domestic risks and external relief. Domestically, the most important factor is the continued cooling of wage growth. For the past couple of years, the tight labor market, where competition for workers was fierce-fueled very high services inflation.
Because companies had to keep raising pay, and then those costs were just passed straight to consumers.
Exactly. So if that pressure for higher wages eases, the costs feeding into services start to moderate. It takes the domestic heat out of the economy.
But, as you and I have discussed before, slowing wage growth, while it's good for the inflation target, it does introduce a different kind of risk for the debt ecosystem.
It absolutely does. Taylor sees cooling wages as a positive for policy, as something that allows for rate cuts. But for the collections ecosystem, slower wage growth presents a very mixed outcome.
How so?
Well, better inflation means household expenses stabilize, which on paper is good for repayment capacity. However, if wages stagnate or even contract in real terms, the ability of consumers to service the volume of their accumulated debt, even at lower rates, diminishes.
So creditors have to reconcile this risk. The MPC's success is kind of based on slowing down the labor market.
Yes, and that deceleration is felt by debtors through tighter personal cash flow. It's a real balancing act.
And what was the second major factor Taylor highlighted? The external picture.
The second factor is all about the normalization of global trade. We spent years dealing with extreme supply chain disruptions, huge container shipping costs, commodity price spikes.
All those external inflationary inputs.
Massive ones. Now, as global trade routes and logistics continue to settle down, and assuming no new major global disruptions, that external cost pressure on imported goods and raw materials eases considerably.
It's like an external tailwind.
A structural assist, exactly. It means the bank doesn't have to rely solely on domestic demand destruction through high rates to achieve its goal.
And to put all this into context, the environment isn't static. The bank already cut its benchmark rate to 3.75% from 4% back in December.
That's right. The trajectory is already set.
And market sentiment is clearly reflecting this anticipation of more easing, too.
That's absolutely right. When you look at what the financial markets are pricing in, they are already anticipating the probability of at least 2 additional quarter-point cuts during 2026.
So the market consensus aligns with Taylor's messaging.
It aligns strongly, or is maybe even a little ahead of it. They're betting heavily on that mid-2026 target holding firm.
So if the market believes it, and a key policymaker is explicitly stating it, the time for a strategic response is right now. Why is this forecast shift so timely? How does it start shaping planning for creditors and debtors today?
The timing is crucial because it dictates business planning, a difference of 6 to 12 months in an inflation forecast. I mean, that profoundly impacts cash flow modeling and risk provisioning for the next fiscal cycle.
Okay.
For creditors, anticipating cheaper funding means their cost of capital goes down. That grants them greater commercial scope to adopt flexible strategies, extend forbearance, and just manage risk differently starting now.
And for the person in debt?
For the debtor, this forecast provides a necessary psychological foundation. It offers a visible path toward eventual economic stability. This prospect of future relief, even if it's a way off, changes their willingness to engage.
Because if you feel like you're sinking with no end in sight, you just disengage completely.
Of course. But if you see a stabilization point just over the horizon, you become open to the idea of a temporary, structured, stepped repayment plan. And that's essential for a successful recovery.
We've established the direction of the macro wind, then lower rates, sooner. Now we need to translate these policy projections into real-world effects. How do these cuts immediately impact the day-to-day operations of debt management?
Okay, so the transition from macro policy to micro impact brings us to 4 core implications. The first, and probably the most easily misunderstood by the public, is that affordability improves. But we have to stress this, that improvement comes with a substantial and pretty complex lag.
The intuitive headline is, of course, that falling rates reduce interest costs. That's positive news. But that caveat, that the relief is not instantaneous, that's operationally vital, isn't it? It can dictate who you prioritize contacting right now.
It is the defining operational challenge of this next phase.
Yeah.
We have to view the debtor population not as one mass, but as 2 distinct polarized segments.
Okay, so how do you split them?
It's based on how quickly their monthly budget feels the benefit of a rate cut. On one side, you have the quick winners, borrowers with variable rate products.
Base rate tracking mortgages, variable business loans.
And, most significantly, users of revolving credit cards, overdrafts. These people benefit quickly, often within weeks, as their interest charges drop almost immediately.
So collections teams working that segment should see a tangible uplift in keep rates on existing arrangements.
An immediate one, yes, because the marginal cost of carrying that debt has gone down.
But the other segment is the vast number of people on fixed deals, which they locked in before the major rate hikes.
Exactly. And that second group will feel no benefit whatsoever until their existing fixed terms expire.
And they have to reprice onto the new rate environment.
Which could still be a massive shock. If they locked in a rate of, say, 2% 5 years ago and the base rate is now 3.75%, even if it falls to 3.25, they still face a huge payment increase when they reset.
So this lag presents a huge communication hurdle. If I'm a collections manager, how do I ethically use the prospect of mid-2026 relief to motivate a struggling fixed-rate customer whose pain is actually going to get worse next year?
It demands segmentation based not just on whether they are in arrears, but on their known repricing date. Operationally, this means collections teams have to manage 2 parallel recovery tracks.
Right.
The positive trend, fewer broken payment plans, will be protracted, rolling out over 18 months to 2 years as these fixed terms expire. You have to use this time for aggressive data collection and engagement with that fixed rate segment, preparing them for the shock of their reset date, not just promising general relief. The second implication is a critical psychological shift, and this is driven by budget stabilization. This often provides more immediate relief to debtors than the rate cuts themselves.
That stabilization is crucial. We're talking about basic household economics. When the rate at which essentials like food and energy are rising slows down, that pressure cooker effect on a budget just dissipates.
That's the key. For the last couple of years, many customers were just stuck in survival mode. Their sole focus was prioritizing essentials over debt, which inevitably led to total non-engagement with creditors.
They literally couldn't afford to allocate even a token payment.
Exactly. But this is where the policy shift becomes so operationally valuable. That survival mode breaks down when stabilization occurs.
And it facilitates that shift toward what you call partial engagement.
Precisely. Once a budget is no longer being actively eroded by relentless inflation, a debtor might find they have a small margin, maybe 50 or 100 pounds left over. That small available margin is the crucial starting point for successful recoveries.
Why is that partial engagement so valuable compared to non-engagement?
Because it shifts the entire relationship from adversarial to manageable. A collections team can now start a realistic conversation about a sustainable, even if it's small, repayment plan. Before, the answer was just zero.
Now, even if the payment is minimal, it establishes willingness.
It validates the debt and it starts the clock on the recovery process. This movement from non-performing to partially performing is what drastically improves the net present value of the whole debt portfolio. It creates a connection.
Let's shift our focus to the institutional side. The third implication is about strategy. If the cost of borrowing for lenders themselves becomes cheaper, how does that translate into their approach to recovery?
It translates directly into greater flexibility and patience. When their funding is expensive, lenders face immense pressure to recover capital quickly.
Right, to redeploy it.
Or just to avoid excessive provisioning costs. When funding costs drop, that pressure eases, and the cost-benefit analysis shifts decisively in favor of customer retention and long-term recovery.
So the incentive structure changes dramatically. It becomes commercially better to wait for a sustainable repayment arrangement than to rush into an expensive, protracted legal process that might yield very little.
And permanently destroy the customer relationship. Exactly. This forces a profound operational pivot for collections teams. They can no longer rely solely on a sort of heavy-handed, standardized approach.
The new focus has to be on crafting truly sustainable arrangements.
Which means setting significantly shorter review cycles for payment plans. You check in more frequently to ensure the arrangement still fits the customer's gradually improving reality.
And that increased flexibility requires an equally stringent increase in documentation standards, doesn't it?
Absolutely. There must be a heightened need for tighter, verifiable evidence of debtor affordability. If a creditor is now willing to restructure a long-term loan, they need absolute confidence that the new terms are viable, not based on guesswork.
So standardized income and expenditure statements.
Mandated. The flexibility has to come with thorough verification, protecting the creditor from future accusations of irresponsible lending or non-compliant forbearance.
Okay, but this shift toward optimism can be a double-edged sword. The fourth implication, then, is about a major operational hazard, the danger of complacency.
We cannot emphasize this enough. Arrears do not just vanish because the Bank of England hints at rate cuts. There is an inevitable and profound time lag.
All the previous cash flow stress, all the accumulated legacy debt.
All the fees, all the interest from that period of high inflation, that inventory of debt continues to dominate the recovery landscape for many months to come.
So firms cannot afford to relax controls and assume the economic tide will automatically lift all ships.
No, it's when management thinks the crisis is over, we can stop the intense monitoring. They ease up on proactive efforts, and before they know it, bad habits creep back in.
Poor data entry, lagging follow-ups.
The risk is operational drift, and the primary metric that gets hit is day sales outstanding.
DSO, day sales outstanding. For our listeners, that's the average number of days it takes a company to collect payment after a sale. If that metric drifts upward, what's the consequence?
The consequence is immediate liquidity strain. If collections managers ease off too soon, DSO will drift upward because debt is staying trapped in the recovery cycle longer. Cash that should be in the bank is stuck in accounts receivable.
And you also see more disputes.
A surge in customer disputes because customers hear rates are falling and expect blanket relief. If they're denied, they complain.
So the message is clear. The economy might improve, but that improvement only benefits firms that have already fixed their internal structural issues.
That is the central strategic message of this whole discussion. The firms that will truly gain the most from this economic window are those that use it proactively to fortify their foundations. They must avoid relying on macroeconomic improvement alone to solve their systemic problems.
This is where we get highly tactical. For our listeners in credit control or servicing, this forecast needs immediate translation into specific action items. Let's start with that mandatory financial planning step.
Okay.
Given the inherent variability in the rate outlook, what level of cash flow and collections capacity planning is required right now?
Creditors must create two distinct, fully modeled cash flow and collections volume scenarios immediately. This is mandatory portfolio management.
Two scenarios. What's the first?
The first is your base case. This reforecasts your expected cash receipts and collections volumes based on the assumption of two distinct quarter-point rate cuts in 2026. This aligns with the market consensus.
So this is your target for success.
Exactly. In this model, you predict a slow, steady reduction in defaults and an increase in cure rates.
And the second critical scenario, the hedge against being too optimistic.
That is the slower cuts scenario. This models what happens if rate reductions are delayed or there are fewer of them, maybe only one cut in 2026. This scenario assumes that stabilization takes longer, maintaining higher levels of arrears for longer.
And the instruction here is to build your operational capacity around that less optimistic view. Why is that the defining choice?
Because collections capacity, your staffing, your training, your tech, is slow and expensive to deploy. But arrears volumes can spike incredibly rapidly.
So you have to be prepared for the worst case.
You build your capacity around the slower cuts case to ensure you're resilient. If you staff based on the optimistic case and the cuts are delayed, you are immediately swamped. If you staff for the slow case and things get better faster, great. You're over-resourced and can redeploy those teams to proactive customer management.
Smart risk management. Now let's move to where the most effective intervention occurs. Tightening up early-stage collections.
The priority has to be placed squarely on day 1 to day 30 arrears. The effectiveness of any intervention just decays exponentially the longer the debt ages.
And this early window isn't about demanding payment.
No, it's about preventing a small, temporary cash flow issue from hardening into a long-term expensive default. The method must be fast and empathetic, yes, but critically, it has to prioritize identifying the root cause of the difficulty.
Okay, next, let's talk about managing expectations. Customers are hearing this rates are falling narrative, so they might start requesting unrealistic concessions.
Creditors need to refresh their affordability scripts and evidence requirements immediately. Flexibility is the goal, sure, but the process must mandate proper, verifiable documentation of income and outgoings.
We can't just grant requests based on public optimism.
No. And it must be justifiable with robust evidence to protect the firm from regulatory risk.
And setting clear boundaries for any commitment is just as crucial as the documentation itself.
Absolutely. Creditors must set specific, concrete review dates for arrangements. Avoid these open-ended promises like, we'll check back in when the economy improves.
That just leads to confusion.
And disputes. You need concrete dates for reevaluation, maybe aligning them with policy review periods or the customer's own repricing dates. It instills discipline.
Finally, we talked about segmentation by rate sensitivity. This has to be an active, ongoing process, not a one-time thing.
It does. You have to segment your book to prioritize outreach to the groups that stand to improve fastest. Variable rate borrowers, users of revolving credit, SMEs with floating debt.
These are the groups whose cash flow will benefit most directly and rapidly.
So you should be contacting them now to propose slightly accelerated or stepped arrangements, capitalizing on their improving future outlook and converting theoretical relief into current recovery.
Now, turning our focus to the collection agencies and servicing teams who manage debt on behalf of creditors, the new economic narrative has created a higher willingness to talk among debtors.
And that opportunity must be seized.
But the communication tone has to be carefully recalibrated. If the message feels punitive, that willingness to talk just evaporates, doesn't it?
It's gone. Communications must be perceived as realistic, tailored, and genuinely supportive. Debtors have suffered accumulated stress. If your outreach just sounds like boilerplate, you miss the opportunity completely.
This increased engagement, combined with that lag in affordability relief, introduces a powerful technique, the stepped payment plan. Can you detail how this works in practice?
Stepped plans are the optimal tool for this transition. The mechanism is powerful. You design plans that start with smaller, highly manageable payments now, reflecting the customer's current strain.
And
Then, the payments step up to a larger, agreed-upon amount that's aligned with a known or anticipated repricing date for that customer's larger debts.
So you're literally synchronizing the repayment plan with the customer's expected rate relief. The payments only increase when their wider budget pressure decreases.
Exactly. It connects the customer's current reality to the future forecast. But to execute this, you need better data integration. The agent must know the customer's key repricing date.
What if the debtor pushes back? They prefer a fixed, small payment arrangement instead of a stepped one with a future increase.
The agent has to frame the stepped plan as the pathway to becoming debt-free sooner. A fixed minimal payment might take 15 years to clear the debt. A stepped plan offers a defined, visible exit path.
So the initial low payment is conditional on the future increase.
Yes, and that incentivizes the customer to stay engaged until their economic relief arrives. When it's done properly, it significantly boosts the chance of arrangement adherence.
Finally, as conditions shift, consistency becomes absolutely vital on things like vulnerability and forbearance policies.
This is paramount. When economic conditions are changing, customers are particularly sensitive to perceived unfairness. Complaints often increase when customers feel they were treated differently from others in a similar situation.
Fairness creep.
We call it that, yes. So, forbearance policies, while necessary, must be applied consistently.
So the action is rigorous internal enforcement and auditing.
Yes. Servicing teams have to double down on ensuring rock-solid consistency. This means mandatory, verifiable documentation for every single decision, standardizing scripts, and ensuring every agent is following the same measurable standard. Consistency protects the institution.
As we conclude, we should widen the view one last time. While Taylor's comments point toward an accelerated rate cut timeline, policy can always change.
Always, we have to monitor specific economic data points that could alter that predicted path, forcing the MPC to pause or even reverse course.
So what are the key watch points listeners should be tracking that could signal a deviation from this optimism?
The first is the nuance in the inflation trajectory itself. Taylor expects the 2% target around mid-2026. However, Governor Bailey has suggested it could be at target even earlier, maybe April or May 2026.
It's a tight window of variation.
It requires close monitoring because it speaks to the underlying uncertainty in forecasting right now. If inflation comes in hotter than either prediction, the whole timeline shifts back.
What's the second watch point?
That's the litmus test for domestic inflation. Private service sector wage growth. Taylor's whole argument is built on this cooling. If it stays cool, it reinforces the argument for cuts.
But if it heats up again?
The bank will stall rate cuts immediately to prevent a resurgence of domestic inflationary pressure.
And finally, the internal mechanics of the Bank of England, the MPC, isn't a monolith.
Exactly. We saw in the voting records that the committee was divided on the last cut. This division means the eventual pacing of cuts could still surprise markets. A divided committee typically favors caution small, incremental cuts.
Okay, this entire conversation has focused on institutional strategy. Let's speak directly to the individual listener who might be struggling with debt right now. What's the call to action for them?
The absolute core advice is this. Do not wait for the rate cuts to materialize before you seek help. Optimism about future economic conditions does not clear current arrears.
Rate cuts reduce the cost of carrying debt, not the volume of it.
Precisely. If you are struggling, engage immediately with your creditor or a debt advisor. Request a plan that is genuinely sustainable based on your current financial situation.
Focus on stability today.
Yes. If your circumstances improve later because of rate cuts, you can always review the plan. But rate reductions provide the most benefit to individuals who are already on a stable footing or actively working a manageable plan. They are far less effective for those who remain disengaged while their arrears just spiral.
Use the prospect of future relief as immediate motivation to secure stability today.
That's it exactly.
So we've synthesized the central conclusion. Moving rates down provides a necessary tailwind for repayment capacity and recovery. But the best outcomes will go to organizations that prioritize action now, accurately segment their risk portfolios, and establish sustainable repayment arrangements built on robust evidence.
Like those stepped plans we discussed, this transition period demands precision, not relaxation.
We've explored how lenders must adapt their strategies. Now, consider the future challenge. How much faster will collections technology need to evolve to efficiently handle the increased complexity of these stepped payment plans, manage the segmentation required, and conduct the rigorous, short-cycle affordability checks we've outlined? Think about the necessary technology investment in data governance and automated precision that will define the winners in this changing environment, separating those who manually manage risk from those who automate resilience.
That is a fascinating concept to ponder because the human-centric and hyper-precise strategy we need now can only really be executed at scale with some sophisticated technological support.
Thank you for joining us for this analysis of the rate outlook and its operational implications.
We look forward to having you next time for more insights.